Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes, but when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
Right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term. PPFAS Mutual Fund. There's only one right way.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
You might wonder that is this the first line or the last line? I would say it's both. The reason this is up here is because it also justifies our existence in some way as investors. It's a thank you to all the entrepreneurs, the promoters, the managers of great businesses that we get to own, and we get to participate in their value system, in the economic force that creates a lot of opportunity for people. And at the same time, it also creates an economic system which is not akin to communism, but it's more like capitalist. Everybody gets their fair share if they are fair. So it's a quote to those guys. But today's topic is actually a little bit somber. A lot has been said about how businesses are built, how they are scaled, how they are grown into large conglomerates, and they become mammoths. But a lot of people, especially in India at least, we have this situation where talking about failure is still not stigmatized, but still people are not comfortable talking about it. When you read accounts from the Western media about businesses that have failed, probably they have a longer business history, uninterrupted business history as compared to India has. You can see a reverence towards understanding why failure is important and what you can learn from that failure so that the mistakes cannot be avoided. So today's attempt is to just understand how businesses have failed and how can we avoid investing in them. So lately I have been obsessed with reading business biographies. I think every alternate book that I have read is about some of the other business or industry. For instance, Gas Wars, which talks about the nexus of politics and business, or Onward, which we discussed during the Starbucks versus Coffee Day presentation, or the guy who wants to go to space and the company who is trying very hard not to fly efficiently, or the best bank everybody likes to like, and a nice book about entrepreneurs and other famous personalities discussing their personal failures or business failures. This is one of the books I found very rare because people talk about very personal situations, and these are some promoters of businesses which are already right now in distress. So it's interesting to listen to some people saying that, okay, I moved up. Or even a candid encounter with the founder of Z, Mr. Subhash Chandra, who bears it all in his biography. Or how activist investors, they go about trying to bring activism in companies where they think companies are deviating from their economic principle. Or we have great biographies for understanding the rise and fall of some of the iconic businesses that were out there. One is the BlackBerry book, and this is Circuit City, which we'll discuss later. There are many more, but the problem with business biographies or any narrative of business is that it is full of some sort of narrative fallacy. And Nassim Taleb in his book Black Swan talks about narrative fallacy addresses our In short, narrative fallacy helps us tell vivid stories from historical facts. And what does this mean? So, whenever we read about something in history, there is this temptation to draw a logical, linear line to understand how that event has taken place. And this is what narrative fallacy is, where you might misinterpret what has actually happened in history by connecting the wrong dots. There are some promoters like Jeff Bezos in the Everything Store who asked upfront in the introduction that how will the author handle the concept of narrative fallacy while studying a business which is still in existence and growing. And very few people are actually aware of the fallacy, but those who are, they understand that narrative fallacy is a bit like this. So you have a bad business manager whose business tends to grow, and in the end, when the business has grown enough, he becomes a smart business manager. Although his nature wouldn't have changed, but the opportunity available to him, or maybe he is in the right place at the right time, which led him to grow the business. This is similarly to what we do in bull markets, when we think that we are smarter than what we actually are, then our stores do better. No introduction necessary. In the past, we have probably extracted whatever these people have written or said in the media and distilled their knowledge into notes and bite-sized checklists and everything. So, we have basically read everything that they have to say about how businesses are run, how character is built, how managements grow and evolve. But something that even they haven't spoken too much about is business failure. And last year's letter of Warren Buffett to shareholders, he mentions 3 things that the next CEO of Berkshire Hathaway should actually avoid. Is to avoid arrogance, bureaucracy and complacency, the ABCs of business decay. Whereas his partner is actually quite blunt. He is saying, tell me where I am going to die and I will never go there. And although collectively these people must have at least 150 years of experience in investing, and they have distilled their knowledge into these bite-sized understanding of how businesses fail. We cannot afford the luxury of just taking that for granted. We as analysts and investors, we need to study and go back and go to the source of these arguments and just understand what does Munger actually mean when he says, tell me where I am going to die and I will not go there. And that is the attempt here to study business failure. But before that, show of hands, how many of you are gamers? Serious gamers? That's it. Have you played games ever in your life? Never played. Have you video games for that matter? How many racing game fans? Not bad. This is the best analogy I could come up with because I spent too much time playing racing games. Imagine this Porsche as a business, okay? This is us, the outsider view of an investor who invests in companies. We see the business, we, with our understanding by reading trade journals, news articles, annual reports, conference call transcripts, meeting managements, doing all the research that we do, we get this view. We understand that where the business is going, where the industry is going. We understand the competitive position of this particular company, where they stand, and what speed they are going. We get this outsider's view. But imagine what a promoter or a business manager sees. Not only does he see what we see, he also sees a lot of other universe inside the car. He sees at what pace he can go by accelerating or decelerating where he wants to. He sees how much oil is in the car, he sees is the engine overheating. He has the steering wheel in his hand. He can easily knock the car on the wall if he wants to. And the reason why we need to study business failures is because a lot of business failures, when you put the business under the microscope after it has failed, the insider view starts to emerge. We get to see how management decisions were made. We get to see how the board has thought at a particular point in time when the business was not doing so well. Or how did the business recover from that point of view by analyzing these old decisions that the managements have made. Another problem, because we don't read too much about business failures, we might end up believing that they don't happen as often. But in fact, business failure is not an exception, it's a rule. businesses do thrive and fail at the same time. So at any given point you have net business growth because GDP over the past hundreds of years is growing across the world. So you can see that net businesses are growing, but there is a lot of churn in the businesses that actually go out of business. Can you read at the back? If not, it's fine. I just paraphrase for you. This is a nice list compiled of business families, top 20 Indian business families, 1951, 1990 and 2015. Although there are some names which are common across the three columns, but you can understand that there has been a lot of churn in some of the business families. And it is quite natural. Some cyclical businesses will go out of fashion, some family factions break up for whatever reasons, and some new industries emerge. So this change happens. This is the natural process of the economic system. So we don't need to be alarmed that, oh, how many businesses failed and how many businesses actually did well. So studying business failure gives you the sense that it's a common act of nature which helps us prepare ourselves that there might be a dud in our portfolio as well. I think one of the most important lessons I learned while reading about failed businesses is you start to respect return on capital a lot more than what we normally would do. So a lot of managers, even today, they want to focus more on growing the profit margin. But the real aim has to actually be to focus on the return on capital. How much money you are deploying and how much returns are you getting out of that. And so somebody did a study, some brokerage house did a study of past 25 years, which companies sustainably gave an ROC of 15% and above. And the list was a handful, I think 15-20 names that they came up with. And this is regardless of growth, okay? Assuming there is no growth also. And that tells you from 5,000 listed companies in Bombay Stock Exchange, we have just a handful of companies which are capable of generating sustainably high return on capital, which beats their cost of capital of operating in India. And that says a lot about how far businesses need to go in order to compete very well and shrewdly to manage return on capital to be higher than their cost of capital. I met a promoter once who made boxes, corrugated boxes. An interesting business. I asked him what is his ROC, and he says ROC is 11%. I said, how much do you borrow money for? I said, I don't borrow money, but if I have to borrow, it will be at least 12%. My cash flows are very lumpy. So I said, how do you justify being in business? He says, I'm just doing it as a hobby. And the problem is there are many companies even listed otherwise. They run like hobbies. And we as investors have to be careful while extrapolating the growth of return on capital. So the management might promise you a lot of things, but you have to understand why is this promoter or this management in business. And looking at business failures makes you a little bit aware of focusing on those points. So a lot of people talk about concentrated portfolios, having just 10 stocks or 5 stocks. And according to me, it invites to some extent some catastrophic failure if you make the wrong choice. And this again goes back to the idea of having an insider's and outsider's view. So I'm of the view that am I going to be able to build a view on this business as good or probably similar to what the promoter or the management has? If my conviction about understanding the business is so high, then it makes sense to have a big position in my portfolio for one particular stock. But apart from that, if you have not researched the company well and yet you think based on your hunch that this is the right time to load up on a particular stock and stay focused in that idea, you are inviting catastrophic failure. And this has been the history of a lot of businesses which people owned in the past. And being aware of that helps because then you realize that you have to be a little careful while picking stocks in the future. So just like in life, business also has, there is no straight road in business. You take one right here and you go deeper into the maze, or you take one left here and you go out of the maze, go new maze. But if you look at businesses, especially when these businesses are studied in detail after they have failed, people start looking at each and every part of the business, right from operations, the human resources policies, then the capital allocation of the business, At the same time, they also look at the relationships that the business could develop with its customers and vendors. Although we as investors do try to understand this while investing in the business, but when you get a holistic point of view of the entire network of that business after it has failed, you get to see the responsibility of the manager is not just to run this business steadily or sustain the sales that they already have, but they have another responsibility to keep the business growing profitably. And if these two are not hard enough, they have one more responsibility, that to maintain the morale of the employees working for the company and make sure that they are all attuned to the same frequency that he is. And that makes the job of the manager actually quite complex. It's not an easy task to run a business. I mean, I'm not from a business family, and my understanding of businesses is mostly from what I read about companies in annual reports and conference calls, meeting people. At the same time, if you ask any person who has run a business, he will attest to the fact that yeah, it's tough and it's not always linear, and one mistake can actually cost you years worth of growth, or one opportune meeting with someone can actually grow your business fivefold. And studying business failures, the most obvious thing is how much we undervalue the role of luck in how the business has shaped up to the way it looks today. And when you read these annual reports of failing companies, you start realizing that each company has a very elaborate plan of turning around the business. And I'm not being condescending, but it is true that they have a genuine plan that this is what we will do, these are the measures we will take, these are the costs we will cut, these are the customers we will tap and make them pay, or whatever. But at the end, it's not necessary that the plan has to work. The plan may easily go on the wayside. And finally, one of the most important lessons I found is, and every time I look at an annual report now, I will really pause and reflect that, am I really paying too much for this business? Am I really paying too much for the growth of this business? What am I really paying for? And these questions are now burnt in the back of my mind when I read any annual report. The problem with reading business failures is that if your cynicism was at 10%, it now goes to 80%. And for a person of my age to be so cynical is actually quite difficult. So if we can reduce the cynicism meter a little bit while studying businesses, we can actually appreciate why good businesses exist, how they are run, and why they succeed, whereas so many others fail. Of course, discounting for luck. But this is really the arrogance of hindsight, nothing else. I mean, we get a chance to judge these companies standing here and looking at the companies and casting the impression that they should have done this and they could have done better. But it's not that straightforward. But there indeed are some predictable patterns of failure which we can generally observe. The first three we saw, what Buffett said, is arrogance, bureaucracy and complacency. And when we dig deeper, we realize that these problems are not just problems of the promoter, but it's the organization who actually grows with the problem. It's like mold. It grows throughout the entire organization if it is not controlled at the beginning. At the same time, there are some problems which are not predictable. For example, businesses fail because of frauds. And no matter how much you read the annual report or the schedules, and no matter if somebody tells you the answer that this is the reason, this is the fraud that the company did, you still won't be able to deduce the exact accounting entry in the annual report and figure out how the fraud actually happened. How could you have understood the fraud before it actually came out in the So we'll exclude frauds from the whole predictability aspect. And then there is regulatory failures. Where a business thought that it had a chance to grow in a particular sector, they invested all their assets and basically rolled the dice and a briefcase somewhere and hope that the business will get the approvals and permissions. But it doesn't work every time. So we have to ignore regulatory failures when you're studying business failures. One of the most interesting aspects of business failures is, and since India has more promoter-driven companies than anywhere else in developed markets, we see a lot of promoters and their families, as they grow bigger, their goals and aspirations change. Some co-promoter might want to grow the business at 50%, but the other co-promoter says, okay, let's wait and grow it at 10% only, and let's figure out a growth plan for the future. And that might create a rift. So previously, people who used to operate as thick as thieves, they can't stand each other anymore. And the family feuds and the drama, they distract the managers from actually running the business. And that's why they create a clueless middle management as well. Imagine, we just saw at least 8 to 9 aspects of business failure, some patterns which we can predict. Imagine what happens if problems come from different sides at the same time. It will be something like this. It's not a case study of business failure. For the longest time, I used to have this view about consultants in private equity companies that they somehow market their ideas more than necessary, or what they have studied more. Their reports and all, they are all jazzed up to the perfection, glossy papers and very fine printing. But when you read a book like Founder's Mentality, which is actually the backbone of my talk today, a couple of guys from Bain Capital had this idea that why not study the most important aspect of why businesses fail, that is growth. And assuming that the business is profitable and running very well, apart from that. So Chris Zook and James Allen, they interviewed cross-section of companies across the world, including some Indian companies. Some very great examples. One is the Marico example, which is quite good, how they distilled the management mentality in the company, founder's mentality in the company. The book is divided in 3 parts. I'm going to be covering only one part of the book. The first part is the founder's mentality, which is how the promoter actually started the business from what passion he had. The second part is how that passion got diluted when the organization grew too much, too big, too fast. And number 3 is how some companies were able to reinvigorate the founder's mentality back into the business. Amazing examples throughout the book. But let's focus on what he has to say about business failure. So he distinguishes growth in 3 aspects. One is an overload of growth. The second part is a stall out, which is a stagnation plateau. And the third is free fall, when you lose all your sales for some reason. So let's pick overload. So the past few years, many geniuses have come up, very smart investors have come up, who were able to predict the futures of a lot of small cap companies or macro cap companies which were otherwise ignored, or people had some or the other reservation. But when the growth and the numbers and the profitability started showing up, these businesses got noticed and they became multiplied, sometimes 20x, 25x, 50x in some cases. There is no problem with that. There is no issue with smaller companies becoming big. But how many of these companies have the systems in place which can handle the same profits if they were 10x from today? How many of these investors, including me, how many of us have actually gone and asked the management, and what are you doing for improving the scale of this business? And are you dreaming 10,000 crores? Are you dreaming 1,000 crores? What is the size of the market? And how well do you think you can grow in that industry? The problem of overload is simply this, that you have too much sales and too few people to run the business in the way it is supposed to be run to sustain the profits that they could generate in the past. This is an interesting quote which nobody says. There is no such thing as excessive growth. And growth is a problem people actually want to have. There are a lot of industries where people are afraid that they might become irrelevant because there is no growth or there is no sales happening. So people don't mind if they grow too fast and they will figure it out along the way. I mean, that's the typical entrepreneurial mindset. Where we'll figure it out. We'll find somewhere. We'll hire a consultant. We will hire some person to do that. It's a fair way to think. But how many times it actually works out? That's the question where we try to understand from business failures. And we have been told countless number of times to look at businesses as an unfolding movie rather than just looking at a snapshot. So we have a few examples lined up. And we'll see how some businesses manage these three stages as per the founder's mentality model. You can guess the name if you want. No points for that. It's a construction company which went out of control. It's an India-based digital company. So when the movie unfolds from FY7 to FY16, here is the PAT numbers and here is sales and debt. The sales, the blue line actually grew to about 8,000 crores, and the debt also ballooned to close to 11,000 crores. And look at the impact on the company's profitability over the past 9 years. If you were an investor in this company, assuming that the company is going to grow, you invested somewhere here, or maybe here, or maybe here. What future would you see this business have when you are getting crippled by your own growth? Although the problem of overload can be superimposed across all business failure types, because this is a problem which all companies face when they are growing. It's just that some companies manage to break out of that and realign themselves to the new reality of bigger sales or bigger profits. Whereas some companies just don't. And like I said, I am trying to oversimplify this problem by saying it's a problem of overload. But there are many mitigating factors which led to this business failing. And probably it's on the brink of failure. Unless they can repay their debtors. Just a hint if nobody has guessed it yet.
No. Income.
Even if we want to have more examples of overload, the problem is overload is everywhere. It's a natural function of business growth, and we cannot use it as an excuse to slot business as they have failed. But stall-out is an interesting example. Stall-out is the phase where the business has grown. It has become complex enough. It has created a middle layer of management. It has created that network of distribution channels and everything. And now the business is unable to execute the founder's idea of growing in these small pockets. Maybe the motivation is not strong enough to reach the frontline employees. And the book actually gives a lot of good examples of how promoters have actually created. So in case of Marico, the example goes that the promoter, Harsh Mariwala, he himself created this operations guideline and he circulated the book to all his top employees who then taught it to their juniors, and that founder's mentality percolated. But not every company can be so systematic. Not every promoter can be so systematic. Stall-out creates some interesting examples because it covers the cross-section of business failure. Not just from the founder's mentality not percolating to the channel, but other competitors entering and the competitive intensity growing, or the business's capital-intensive nature can also be a problem for several companies because they have already invested for the past and the growth has stalled. So these cash flows are not enough to sustain future growth. A lot of great examples in this and some iconic companies. I'm sure you will remember this company. It's a very famous consumer electronics company. So if you look at the numbers in FY19, from close to 600 crores sales, they had a meteoric rise to 1600 crores of sales. And on the back of increasing return on capital employed and return on equity. It's a consumer durables business, so profit margins were not great, but they were reasonable for the company of their size and their operations. But something happened. And like I said, several factors worked together. In this particular case, not just the competitive intensity not just increased, they also had an internal feud between the promoters, the co-promoters, which led them to completely ignore their operations. And you will see that in the quarterly numbers as well. You will see even in the annual report, when they discuss the business industry and industry's growth, you will realize the tone of their voice that they were not so happy with their own growth. And mind you, before this, the year before this, they have grown 50% from that. So it's a growing industry. They had all the advantages of being the incumbent player, and people have already opened up. But other competitors came in and took their market when they were busy fighting each other. Again, if somebody recognizes this brand. This is a case study from outside of India. The reason it is interesting is because from the point I started looking at this company in 590, the company had already been in existence for the past 30 years. At this point, the company was one of the biggest electronics retailers in the United States. At their peak, they reached a revenue of $12 billion, and the peak ROC was about 20%. A very decent ROC for a retail company who is trading in other companies' manufactured products. But this example has to be studied from a different point of view. So Circuit City, and the guy who wrote this book is the son of the co-founder and also had served as CEO of the company for 12 years and was the chairman of the board till 2000. So he has seen the company from a very intimate point of view as how the business grew, because he was seeing it in the family every day. And the father brought news from the company and he was with the company as an intern for a long time. And you can see how the company has grown. You can also see the change in market dynamics and how the change in management's mindset. Just to give an illustrative example, BBY is Best Buy, which is currently the biggest retail store, electronics retail store in the franchise in the US. Circuit City, a year after Best Buy was created, had average sales per store higher than Best Buy. They were starting up, they had their teething issues. As the cycle went on, as the years went by, you can clearly see Best Buy was doing something different. Or maybe they were eating Circuit City's business. Sales are not the right indicator. Look at profits per store. If you look at profits per store, Best Buy struggled for a good 12-year period. And then it led to a peak of profits because they had completely decimated the business of Circuit City in many of their core native markets. I like the idea of this book, which covers title is very interesting. It says good to great to gone. And this is the only reason I picked up the book. There was no other reason. I had no intention of understanding what Circuit City did. So Jim Collins, the famous management consultant, he wrote a book called Good to Great, and where he puts these different templates of how businesses grow, how small businesses become great businesses. And it's a play on that title, where Alan Woodsell says, yeah, I acknowledge what he says, and we did that, and we still failed. And in 2008, Circuit City shut shop. But that's not even the most interesting part of the book. The most interesting part of the book is these 5 stages of grief, which every person goes through. It's a very famous model in psychology. So, at each stage of grief, so for example, when Best Buy decided to enter the market of electronic retailing, the management is, in their discussions, they are saying, how is it possible that a new company, such a small company, is competing with a giant like us? We have all the advantages, we have the economies of scale, we have capital. How dare they compete with us? After a few years, when the numbers started showing up that Best Buy was getting their feet on the ground, they went to denial. They said, oh, it's a small time story. How far can they go? During this time, Best Buy did their IPO. Stock tanked afterwards because the numbers didn't show up. They did a debt issue and they had a cash flow crisis. But they powered through it for some reason. The only difference between Circuit City and Best Buy was the format of the retail store that they had. And it's all the open floor format that we see today. Whereas Circuit City had these personal attendants who will come to you and tell you how the business works, how the product works. So, well, it's a short-term story, nothing to worry about. After a few more years, the language of the management changes. They start saying, oh well, they're doing something right in some new areas where we are not present. So why don't we just emulate some of their practices and improve our businesses? So noble thought. And they did that, despite not having enough cash to remodel some of the stores. Then it hit them. that their sales and their profits were already being eaten by somebody else. And there was no escape from it. And finally, in 2007 and 8, the company decided to wind itself. They realized, they finally accepted that, yeah, it's a difficult business to operate now because the competition has become much better than us. There is one slide which is not here, deliberate. It's the graph between retail sales of Best Buy and electronic sales on Amazon. And the reason is not justified because it has not played out yet completely. So let's wait till that book on Best Buy comes, or that book on Amazon comes. That's how they grew in the electronic retail space. And then we'll talk about it. The nastiest part of the book is the free fall. It's like you're standing on a carpet and two extended guys come and pull the carpet out of under you and you fall. This is like free fall. It happens so suddenly that the management has no control over their destiny after that. An example of an iconic four-wheeler Indian brand. Any guesses?
Fiat or a middle.
98, 1400 crore sales almost. Peak ROC of about 20%. Reasonable margins. An iconic brand by all means. FY16, factory shut, workers stranded, zero sales, unions, litigation, the works. So at some point, the glory, the business was like this. And the interesting part is that when Ambassador was the way it was, Royal Enfield was in the same state. And I'm not saying that the dynamics of four-wheeler industry and the two-wheeler industry are similar, or the brand loyalty for a Royal Enfield is similar to that of an Ambassador. But it's interesting that two different management perspectives, two separate products, two separate brands, but in the automotive category can actually create such completely opposite results. This is Ambassador now. This contradicts. This is my favorite example. So, an addictive smartphone maker from Canada. Any guesses?
BlackBerry.
So, they struggled. They did not get the sales upfront. But at the peak, they had $19 billion in sales, profitability of almost 40% of ROC. It's quite something. And somewhere here, something else happened. The iPhone was launched. But it's still interesting that despite the iPhone being launched here, the numbers were affected here. So they had a 5-year run of selling their product, and of course the Android was catching up, iPhone was catching up in the market share. But they had 5 years of time to understand how this business could actually make BlackBerry the biggest smartphone maker in the world. And this is exactly what this book is about. So this book talks about the iconic founder Mike Lazardis and Fallacy, his co-CEO. They managed the company together. And this business talks about the behind-the-scenes story. So there are businesses written by official biographers who have covered the entire story. But these two journalists, Jackie McNeish and Sean Zirkoff, they actually went behind the scenes, spoke to ex-employees, spoke to ex-board of director members, spoke to investors who were there at the company at that time to gauge how the management communicated with the investors. And they built this entire story of how this business grew, stagnated, and fell, or free fell. So, Mike Lazardis was actually right when he invented this device. And it's okay if your fingers are shivering, piece out of it. I remember people, so my cousins who used to have BlackBerry, they were like chameleons. One eye was always on the device. And they changed the way business is operated. And the book has some amazing examples of how the CEO himself was one of the biggest salesperson of the device. So he used to attend all these conferences, not tech conferences, where device makers go. He used to go to legal conferences. He used to go to financial conferences. And he used to use his Harvard alumni network to meet with these heads of companies and just casually pull the device and use it. And they will ask, what are you doing? I'm checking email. How is it possible? He said, yeah, this is the company I run and we have this device. Can I get one? When the CEO got the device, you directly went beyond the Chief Information Officer or CTO's role, who would go through the budgeting and the bureaucracy of ordering the device. And the CEO said, I want the entire management team to have these devices so we can stay in touch forever. And that's how the device actually became prevalent. So, BlackBerry's success was the validation of Lazard's counterintuitive bet that professionals wanted less, not more, mobile communicating. And in this case, the less meaning the efficiency with which we use the 2G bandwidth. And now we know how slow 2G connections are. We use 4G and 3G. And now getting an email is not a big deal. But actually the technology is less efficient. It consumes more data. What they had in their software was a very efficient system of routing data packets in a very efficient way. So you can download more emails and read them at your leisure. So it's not necessary that a better device will always survive. Sometimes people did not want efficiency. People wanted more services. People wanted more features, more apps. And they had 5 years to catch up, and they did not. So the book is quite instructive in how management decision was made. So for example, there's an instance in that book which says when the company was growing, when they realized that they have broken through the barrier of sales and they can now ship as many devices that they can make, they hired an ex-GE executive to manage the operations. And when he came in, the company was a big Excel sheet. There was no SAP software, there was no planning of how the inventory will move, how the working capital will be managed. And this guy instituted that. And we can see that this is the overload phase where the company was growing beyond their capability to manage themselves. And yet they got somebody from outside who systematized everything. They had a good run for the next 5 years. Yet at the leadership level something changed. They still kept saying that their technology was so good that nobody would want. No telecom provider will want to have an iPhone on the network. It would hog so much of their bandwidth. AT&T networks failed the first year when iPhone was launched, which the service has warned people that it will happen. But people wanted the iPhones, so you cannot convince someone beyond a point. It's a pretty device. I never use it. People who use it, they swear by it. There are many more such examples, and we can go on and on about this. And the more we dig into them, the more patterns similar to these will emerge, and you will figure out that all businesses, although are not made same, there is some similarity between them. There's a line in that BlackBerry book. When a business declines, it begins gradually, almost imperceptibly, until so many failures pile up that the unraveling arrives with unnerving speed. And in the context of that book, so many decisions were made which were incorrect. And now that we see that we need an app store, we need a good OS, all these decisions were already made by companies like Google and Apple, and they went ahead with these decisions and they grew the market in that way. And from the arrogance of hindsight, you can see that BlackBerry should have also made that decision. It wasn't so easy. Before we conclude, I will leave you with this one thought. Harold Jenny was the former CEO of Untitled, a manufacturing conglomerate in the US. He says that it is an immutable law in business that words are words, explanations are explanations, promises are promises. But only performance is reality. And we as investors cherish performance, and we sometimes are unforgiving in judging businesses when they fail. I think failure also deserves some attention in order to learn better and become better investors. Thank you. Judging by the energy in your claps, I can know that it's a solemn topic and we cannot discuss too much about it. But if you have any questions about it,
take a very specific example of this Reliance Jio. My friend here is sitting next to me. No, I understand that they have invested around 1,50,000 crores. These numbers are outside my understanding. I don't understand what kind of turnover they can do, how they can generate any ROC at this level. But how do you analyze such a business? They have a lovely core business, they have a lousy expansion in retail, and now they're going into something on a much bigger scale. how do you actually put your presentation onto something like this if you have to study it?
I wouldn't want to preempt the outcome of what is going to happen, because the telecom industry itself is based on heavy capex. So it's not just them, every other player also has put in similar amount of money over the past decade in building these networks that they have. So without assuming that something will work or will not work, we don't know first of all the market impact of this new service provider. And probably I will wait for some more data to understand. I wouldn't want to be so arrogant as say that okay, itna paisa dana hai, how will you generate money? There might be a business proposition at some price point, or the person investing that kind of money may have the wherewithal to sit through a long bear cycle in that business and ride the initial wave. If you look at this particular chart, and I really had to read the annual report of Best Buy from that point. So this blue line is Best Buy. Okay? It took them 12 years to actually break out of Circuit City's stranglehold of efficiency. So they were growing obviously, and in any growing phase, you cannot have too much efficiency, you cannot have too much focus on margins. The margins were much below, half of Circuit Cities. At the same time, once they realized that they were investing in the right direction, because the sales per store were increasing according to their metrics. So at this particular point, the metric changed. Once they had enough number of stores, they started thinking more of profitability. And this is in 1998, so Amazon had just started. Did not have e-commerce to disrupt them at that particular point in time. And they had a reasonable business model. And not just this, they also understood that they can poach other OEMs who were selling with Circuit City to sell exclusively with them, and they gave better rates to them for a while. Now, all these things take time. And if you have the capital to survive for 12 years and realize or maybe evolve into this new business model, then that opportunity has to be given to any business, including Reliance, no matter how much capital you put in. I hope it answers your question, but
Basically, they are in it for the long haul. So
in
the
short,
investors
I don't
have 12 years patience. That's the bottom.
yeah. So, I mean, not to disrespect Circuit City. Circuit City made amazing amount of money for shareholders. It's not that they did not. Best Buy also made tremendous amount of money. But like I said, the slide which is not there, you superimpose Best Buy stock price and Amazon stock price, you will froth in the mouth. There is nothing else you can do. It's amazing.
So there must be some time or some indicator when you are studying ROC and all those things and reports. Somewhere you feel, okay, now the deadline has started. I don't know if you come across any of your readings that this was probably a time that, okay, 2 quarters, 3 quarters, maybe 2 years or 3 years, the ROC kept going down. So now this is like a serious signal that this business is going up. I mean, leaving aside common sense, just looking at numbers purely. If you come across anything like that, you just said, okay, now this is the end of this business.
So it's not the end. You can see there is some stress.
Yes.
But there is always a reason to that stress. So with that, you have to also study where in the cycle that business is and where in the capex cycle that company particularly is. So the sales cycle is separate, but if the capex cycle is not favorable or they did not plan it perfectly, and it will never happen perfectly. The sales cycle can actually, so some businesses will have a later bloom, while some other businesses may have.
Very few examples of people who have actually gone out from this phase and actually had some exponential growth.
There are many, but at a cost of profitability. And like you said, a few quarters is too short a time span to actually determine that this is going to be a basket case. You really have to see it play out. And that's the problem of investing from this point of view. So it's easy to become cynical. It's okay. No, you keep that mindset in your mind that this is gone. And that's the risk we have. And that's why I personally cannot maintain a very highly focused portfolio in such declining situations. I may not know some things. So in case of that business, which is neighbors, envy and almost pride, we couldn't have predicted that the management will find. Couldn't know. Until somebody in the media did some investigative work and figured out that there is a tiff going on, there is some court case somewhere, they want to split the businesses. This company still exists, by the way. It's just that there is no profitability anymore because they acknowledge in the current annual reports that external competitors have come into our country and they have taken the market. People have more variety now and they cannot. And the price points will never go up.
Upside also. He asked me which company it is. That was Mark Electronics. Yesterday it was on 20% upside.
What am I doing here?
So when he goes to, and today 10%. But don't tell him. He's very nice.
So, and there's one more thing which is missing from this presentation is the stock charts of all these businesses. And it's deliberate because I don't want to taint anybody's view as to how the stock performed versus how the business is performing. And if you just look at the business, it's beautiful to understand some of the reasons which come out later on, how things fail. And that's why you protect yourself sometimes. And for Karthik, your question, the answer is not straightforward.
Yeah.
You just need to keep watching the competitors and the space and overall industry growth. So my biggest concern is trying to get closer to the insider's view as possible. And if I'm not able to get here sooner and trying to understand what metrics the management is looking at, are they serious of driving this business the way it's supposed to be driven? Will he break at the wrong time or whatever? I need to understand these things, and these things come out eventually as you keep tracking businesses. And probably experience of looking at many businesses should help. Anybody else?
How do you kind of find out that some businesses now become falling grace, and now you want to? How do you see a spotting thing that you can raise right from now here? Like Britannia was example, times it's announced suddenly they did something, management changes anything, now it's back to. There are many businesses in this way. At what point do you feel that it's a gone case completely, or there's some life left and things can turn around? How? I mean, it's a trap. It can be a trap.
Yeah.
So how do one decide what factors or what intuitions you have?
It's a very good question. What intuitions do you have to realize when the business will turn around or when it will fail completely? I don't have intuitions. Probably my experience is not so great and I will figure these things out. But from previous examples of how businesses have come back, if you read the annual reports, if you read the conference calls, if you see the quarterly growth in businesses, you can see changes which you can quantify. You can see that the margins were improving somewhere, or you can see that the management was spending much more than the competition in advertising and marketing themselves. And again, it's a maybe. Maybe that leads to, so even right now, my RC spends a lot of money on advertising. You can see ads coming up, but that does not necessarily mean it translates to sales. So, watching and waiting probably sometimes helps. I'm not the kind of guy, I'm not a VC investor where I will want to put money based on a prediction. I'm more of a kind of guy who will wait for some evidence to come and then start building my position. And if it is too late, then it is too late. I will move. But I need to understand what the management is thinking. Are they serious about not repeating what they did in the past? So Britannia is a wonderful example of how distribution channel and sales efficiency can actually change your business model. At the last touch point, so if you talk to any of the sales or distributing people of Britannia, they will tell you how they change their business model to keep more SKUs at the retail level and not too many SKUs at distributor level. How they created financing links to help the distributors carry more inventory. How they help people set up more warehouses, bigger warehouses. All these things, you have to see the market for a while and probably see the business grow. And again, it's not a quarterly game, it's probably a couple of years or 3 to 4 years time when you actually see the results playing out. So if you are a patient observer, not an investor, patient observer, you might actually spot these trends. And if you are a patient investor, you will come way too early and you will not mind the capital efficiency in your portfolio. And then you will make the money. Or not.
Categorize different business groups at various points in time in one of the slides. So today, if we are talking about 2015 and all these business houses, we have those 3 categories of A, B, C. If any one of them or any few where your thoughts are that they are in this category, that they are being arrogant or bureaucratic or some kind of complacency is going on. If you could just give us some thoughts on what you believe where they are placed today.
Masala. Perfect question.
Good question. So you want to know out of this list of 2015 top 20 business houses, which ones will I put in the A, B and C of business BK? I think look at leverage and the ability to repay that money to the lenders. Look at the intention of repaying that money to the lenders. That will probably tell you the arrogance of any group. Look at how many industries they are operating simultaneously with the same business model. Borrow too much, basically take your capital out long time back and just run the business on the lender's money. And if it fails, it's the lender's headache and you will get the assets. I have taken my money out already. You can spot these companies, there are few and you know them. Those are the A's in this list. These can be all companies. Bureaucracy is a common thing in any big company. It's how you carefully work around the bureaucracy and make sure that it doesn't grow beyond a certain point. That is the ability of management. There's a company here which changed its CEO a couple of years ago. I won't name it. It had this problem of bureaucracy where decisions were not being taken. The cash pile in the company was continuously building and ROCs were suffering because of that. They weren't even giving the cash back to shareholders. They weren't even acquiring any strategic businesses and their existing business was stalling. And somebody had to do a shock therapy to their business by introducing somebody else from outside. Hopefully that thing has changed now. Metrics should improve. And I think bureaucracy is a common part of all big companies. You cannot avoid it. Even smaller companies sometimes. C is a tough one because that only plays out in hindsight. You never know which management was complacent enough not to change. So if you read Buffett and Munger, they will say that sometimes not doing nothing is the best thing to do. And we may have to give the benefit of doubt to some of the managers who may not want to participate in the next big thing. They think it's not worthy their time. Their existing business keeps doing well. They may have some hiccups in between, but they can keep doing well. But complacency will always be apparent after a few years when you can see the decline happen. That is one aspect I have not been able to predict any time. Even in ourselves, today we might think that we are the most active and proactive people in the market. We might be not doing some things which only few years down the line, oh, this company ka report karna chahiye. Whatever. This business should have been looked at in detail. I hope it answers some of your questions.
Yeah, in a way.
Able to realize this one.
I said a specific question. You have Infosys Is it going down or is it going to give the weather profit?
It's a very tough question. What's the future of Infosys?
You just mentioned
The honest answer is, I can only guess to some extent that, like all the big IT companies, they will also face that problem, probably face that problem, where their core business or existing business might be facing a faster decline than their growth in the new business. So that might stall the sales to some extent. But on the other hand, if they are able to take market share of some other competitor, and which always keeps happening. So among these top 10 IT companies, IT services companies, they will always shed some client here, add some client there, and that churn keeps happening. So you may not see that decline happen so fast. And parallelly, if they are able to grow the other newer areas of business at a faster rate, then actually it might be a great bet. But at this point in time, I cannot say. I track technology sector very closely, and I track Infosys very closely, but I don't have the insider's view to understand how the wheels are turning and what metrics are actually working. Although they are fairly transparently disclosed, they have two conference calls, not just one, every quarter. So it's a tough question. But I think overall the tech space has had its high growth days behind. And now it's a matter of separating the boys from the men to some extent. As to who will actually grow and create these newer technologies and help their clients better at a lower cost. In fact, in this case, you might face a problem where companies shrink in size because the revenues may decrease and they will commensurately reduce their costs in order to maintain the profitability. That's a possibility. Although there is no hiring freeze at the moment, companies are still hiring thousands of employees every quarter. But this has to play out. I'm not invested in Infosys. I track it regularly. It's a good question. I think the same way. Is it? Where is it right now?
Same chart, Tata is number one for the last 50 years.
Right.
What is like 1 or 2 points that stood out? Because apart from 1 or 2 companies, I don't see many of the Tata companies doing exceedingly well in the sector. Tata Steel or Tata Motors also, apart from Jaguar, it is not much. The TCS is only the shining star. The rest you come businesses, they are not sense started. What they have been doing for the last 50 years that users to the party compared to their competitors. It's very different, they are very bureaucratic organization the way we understand. You don't have everyday innovations there. So what made them take the last 50 years?
The question is what made Tata Group stay on top right from 1950s till now. So I can assume, I have not studied the history of Tata Group, but I can only assume that they were one of the biggest asset owners at one point in time. And they have played through the cycles, they have survived through cycles, they have gone into new industries, they have pioneered the growth of, say, Jamshedpur and places like that, which was unheard of in India at that time, to adopt the city and make it the biggest steel plant in the country. Or TCS for that matter. Who would have thought in 1983 when the company was there, that it is going to be the biggest marketing company period, 2016. So these things are not planned. And I disagree, or I somehow don't agree completely that it is a bureaucratic company, because bureaucracy is necessary. You require a layer of management in order to organize and manage the operations. And that bureaucracy cannot be ignored. And they have had a very good talent program, Tata Administrative Services, which has created amazing managers. Probably they are spread out in the industry now. But they have done a lot of management innovation, which has led to maintaining the growth and profitability of many of these companies. So I wouldn't discount them completely as they're not done well. It's just that their time frame is much larger than ours. They might be thinking generations, we are thinking next 5 years or 3 years. So from our point of view, the question is very valid. From their point of view, they can say, okay, fine. For them, it's as usual. Everything is as usual. So, you had a question?
Yeah, just an observation on the third group, with Aditya Birla group. So, in the last 2 decades, the management keep changing its thought process. For example, they created one company where they merged everything 10 years before. So now suddenly they want a different structure. They want to break that company. And so, what's the thought process? Do you think the management going through, or and case study, what is, are they feeling left out in some of the business, or they, I don't know, just the thought, what do you think? What's happening?
All good questions. The question was, what do you think of the third family, Aditya Birla Group, and what is their thought process as to the past 25 years they are merging and splitting off and breaking apart their businesses? Good questions. I haven't tracked the group as such, so I won't be able to answer it in a meaningful way. And I know as much as the media knows, but I have not studied it. But it's a good question. I will go from yes.
How do you judge from the outside of minority shareholders? This company has too much bureaucracy or too little. You said that one reason of failure is you don't have enough management bandwidth. Other extremes that become bureaucratic. From the outside, how do you judge?
It's a good question. What he's asking is, how do you judge from the outside as a minority investor how intense the bureaucracy is? I mean, do they have enough people or do they don't have enough people to run the business? So one thing I do to get a handle of that is, I go through my LinkedIn profile, find people who are working in that industry, and if there is a person just 2 hops away from me, I initiate that connection. I talk to them about what their work is. I don't ask them about the company. I just ask them from a curiosity point of view what your work is. And because it comes through a connection and they have a mutual link in between, it becomes easier to ask these questions than cold calling people. And people will give whatever answers they want to give. That has so far helped me understand what communication is coming from the top management. And you have a basis to understand or compare their communication with what they are communicating to the investors through the conference calls or annual reports or whatever news or the media. So if you find too much dissonance over there, you cannot pinpoint that this is the reason of bureaucracy or whatever, but then you can know that there is something else happening which you are not aware of. And there is a sample size bias. You cannot get enough people from all different parts of the company and different seniority or junior levels to really understand it. So, interesting, it can be worked on, but it's a nuanced metric. It's not something where you can put your finger on that. This is bureaucracy and this is not.
What kind of communication, like, for example, I don't know if I they're quite honest. But like for say B2B business or industrial business, what indication where you don't have a touch point?
The question is, in the B2B industry, how do you know how the business is doing when there is no touch point? Whereas in the B2C business, you can actually have different touch points communicating to you about how the company is operating. It's a fantastic question. That's the same problem even I face. And it just requires better networking. You have to go out and find these experts and figure out what they know about the industry, talk to some of the vendors or the competitors. So for example, I went to an AGM recently and had a nice chat with the promoter and I asked him, which is the other competitor in your business which you admire the most? And he, without even finishing my question, he had the answer ready. And that kind of confidence in some other company also gives you some indication that there is something better happening there. I can never assume that I will know the entire internal workings of a company to the extent. So, because I'm not a private equity investor, I am not invested for the reason that I want to change that business. I am there as an outside investor to be part in the growth story or the value unlocking, whatever you can call it. So, this has to go along with the fact that how much I am willing to pay and should I have to weigh the risks and rewards from that point of view. So if I cannot figure out at all any association between the businesses, then I will never want to invest. I will never know certainty of the sales or the earnings or the margins. But if you can find those connections who will help you explain the supply chain and the value chain of the industry, you might get some idea. On a probabilistic basis, I am okay.
Just to rephrase this, what are the dead giveaways that any company should give away?
I don't know what is the dead giveaway of a bureaucratic function. Probably try calling up one of these companies, set up a franchise for them, and just see how much longer it takes for them to respond to you. And probably you will know. This works actually. I've tried it with some consumer companies or some companies which require franchising. Some response, some keep pestering you. Anybody else? Great, thanks. We'll break for drinks and dinner.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.